You were told debt is dangerous, that loans trap people, that banks win and borrowers lose. But what if everything you believe about borrowing money is incomplete? What if the real divide is not between people who take loans and people who avoid them, but between people who understand leverage and people who fear it? Think about it. The same bank that rejects one person is willing to compete for another. The same system that creates debt traps also creates billionaires. So the question is not whether debt exists. The question is whether you know how to position yourself inside it. Let's start with a simple shift in thinking. Debt is not an enemy, it is a tool. And like any tool, it can build a house or destroy one depending on who uses it. A hammer does not decide whether it builds or breaks, the hand behind it does. There are people who borrow money to buy liabilities, cars that lose value, lifestyles that drain income, and then they call debt a curse. But there are others who borrow to acquire income-producing assets, properties, businesses, systems that generate cash flow long after the loan is taken, and they call debt freedom. Now, imagine two individuals. One avoids debt completely and saves slowly for 20 years. The other understands leverage, borrows strategically, acquires assets early, and lets inflation and cash flow work in his favor. 10 years later, one is still working for money. The other has already made money work for him. This is not about risk-taking blindly. It is about structure, because debt without structure is chaos. But debt with structure is acceleration. And here is where everything begins: awareness. If you're listening to this, you're already ahead of most people who never question how money really moves in the system. But awareness alone is not enough. You have to build a mindset that banks don't fear borrowers, they fear risk. And your job is simple: reduce risk in their eyes while increasing opportunity in yours. Before you continue, subscribe, like this video, and comment what surprised you most so far. Your engagement helps push deeper content like this to more people who need it. Now understand this clearly. The system is not designed to keep you out. It is designed to reward those who understand it. And once you see debt as leverage instead of danger, the entire financial world starts to look different. Most people think banks are powerful because they control money. But the deeper truth is more uncomfortable. Banks don't actually want your money. They want your reliability. They want predictability. They want certainty that when they give you capital, it will return with interest, on time, without risk. Now imagine walking into a bank not as someone asking for approval, but as someone presenting a low-risk opportunity. That shift alone changes everything. Let's make this real. Picture two individuals applying for a loan. The first walks in anxious, hoping for approval, trying to convince the banker they are good enough. The second walks in prepared. Clean credit history, stable cash flow, clear asset plan, strong reserves. The first is evaluated. The second is negotiated with. Same bank, same system, completely different outcomes. This is why wealthy individuals don't ask for loans the same way most people do. They structure themselves in advance so that banks want to compete for their business. Because when risk is low and returns are stable, capital flows toward you naturally. There was a small business owner once who struggled for years to get funding. Every rejection felt personal until he realized something simple. His financial profile was unclear, unstable, and reactive. He changed his approach. He built consistent income records, reduced unnecessary debt, increased liquidity, and waited. 6 months later, the same bank that rejected him earlier offered him better terms than he originally requested. Nothing about the bank changed. He did. Before you continue, subscribe, like this video, and comment if you've ever been rejected for a loan or financial opportunity. That experience often hides the exact lesson you need. Now here is the deeper idea. Banks are not emotional. They are mathematical. They calculate probability of repayment, stability of income, and asset strength. And when your profile improves those probabilities, you stop being a borrower and start becoming a client they want to retain. This is where most people miss the game. They think approval is the goal. But in reality, approval is the starting point. The real power is in the terms you qualify for. Because in finance, the cost of capital determines everything. Lower cost means higher spread. Higher spread means faster growth. And faster growth compounds over time into wealth that looks almost unfair from the outside. So the question is no longer, can I get a loan? The real question is, can I become someone banks compete to lend to? And once you understand that shift, you stop chasing money and start designing your financial identity around it. Most people don't realize that debt is not dangerous by default. What is dangerous is confusion. Confusion about what debt is actually doing inside your financial life. Because when you strip away emotion, debt is simply a transfer of future income into present capital. Nothing more, nothing less. But here's where things split. Good debt and bad debt are not about labels. They're about outcomes. Good debt is structured in a way that generates income greater than its cost. Bad debt consumes income without producing anything in return. One builds capacity, the other drains it. Let's take a simple example. A person takes a loan to buy a car. The car depreciates immediately. It costs money every month. Fuel, maintenance, insurance. No income is produced. That is financial leakage disguised as ownership. Now compare that with someone who takes a loan to acquire a rental property. The property generates monthly rent. That rent services the loan and potentially produces surplus. Over time, inflation increases rent while the loan remains fixed. The asset grows stronger while the liability stays constant. Same concept of debt, completely different outcome. There was a story of a young entrepreneur who feared loans his entire life. He believed debt meant stress, so he avoided it completely. Years passed, and while he stayed safe, others in his field scaled faster, acquired assets earlier, and built systems he could not catch up to easily. The irony was not that he lacked ability. It was that he lacked structure. When he finally understood leverage, nothing changed in the system. Only his understanding changed. And that changed everything. Before continuing, subscribe, like this video, and comment whether you currently see debt as risk or opportunity. Your mindset at this stage will determine your financial direction more than your income ever will. Now here is the key truth. Debt itself does not create wealth or destroy it. It amplifies your existing financial behavior. If your decisions are weak, debt accelerates losses. If your decisions are strong, debt accelerates growth. This is why wealthy individuals do not fear leverage. They respect structure. They design risk. They calculate spread. They ensure cash flow stability before they ever borrow. Because in the real financial world, it is not about avoiding debt. It is about controlling it. And once you understand that, the idea of good debt stops being theory and starts becoming a tool you can actually use to move forward. If you want to understand how wealthy people think, you have to stop asking, how much money do they have? And start asking, how is their money structured? Because wealth is not stored in bank accounts. It is structured in systems of capital, cash flow, and leverage. Most people think the wealthy avoid debt. The reality is the opposite. They use debt differently. Not emotionally, not randomly, but strategically. Every unit of borrowed money has a purpose, a return expectation, and a structured exit plan. Think of it like this. A normal person borrows money once and hopes to repay it as fast as possible. A wealthy person borrows money, uses it to create or acquire an asset, then uses the asset's income to manage the debt while expanding further. The goal is not just repayment. The goal is expansion while maintaining stability. There's a simple mental shift here. Poor thinking says, how do I get out of debt? While thinking says, how do I make debt pay for itself? A real estate investor understands this deeply. If a property produces monthly cash flow higher than loan repayments, the debt is no longer a burden. It becomes a bridge that connects today's capital to tomorrow's equity. There was an investor who started with almost nothing. He didn't avoid loans. He respected them. Every time he borrowed, he asked one question. Will this generate more income than it costs me? If the answer was no, he walked away. If yes, he moved forward carefully. Over time, his portfolio didn't grow through luck. It grew through structure. Now here is what separates wealthy thinking from average thinking. Wealthy individuals don't think in terms of debt or no debt. They think in terms of return on structure. Every financial decision is evaluated through how it strengthens or weakens the system. Before you continue, subscribe, like this video, and comment what you currently use debt for, if you use it at all. Awareness is the first step toward control. Because here's the truth most people miss. Wealth is not created by income alone. It is created by how efficiently income is converted into assets using leverage without breaking stability. And once you start thinking this way, debt stops looking like a trap and starts looking like a design tool. A tool that either builds acceleration or creates friction depending entirely on how you use it. If you've been taught that saving money is the ultimate path to wealth, you've only been given half of the story. Saving is important, but saving alone has a hidden ceiling. That ceiling is called inflation. Inflation quietly reduces the value of every dollar you don't put to work. So while you feel safe watching your savings grow slowly, purchasing power is often moving in the opposite direction. This is where the mindset of wealth begins to shift. Wealthy individuals don't just ask, "How much can I save?" They ask, "How can I preserve and multiply value over time?" Let's make this real. Imagine someone saving money for 15 years, putting aside a portion of income every month. It looks disciplined, responsible, even admirable. But during those same 15 years, asset prices, real estate, businesses, and investments may rise significantly faster than their savings account. So even though they worked hard and saved consistently, their buying power may not have increased in the same proportion. Now compare that with someone who uses savings as a foundation, not a destination. They keep reserves for stability, but they also use leverage carefully to acquire income-generating assets early. Over time, those assets grow, produce cash flow, and increase in value. Inflation, instead of hurting them, becomes part of the engine that pushes asset values higher. There's a story of two friends who started working at the same time. One focused only on saving. The other saved, but also studied how money flows through assets. Years later, the saver had money in the bank. The other had assets producing income that exceeded his salary. Same starting point, different understanding of money. Before you continue, subscribe, like this video, and comment whether you currently prioritize saving or investing. That single habit reveals your financial direction more than you might realize. Now here's the deeper truth. Saving is defensive. It protects. But wealth is built through controlled offense. That offense is not reckless spending or gambling. It is structured allocation of capital into productive systems. This doesn't mean saving is wrong. It means saving alone is incomplete. Real financial strength comes from balance. Reserves for safety, leverage for growth, and assets for compounding. Because in a world where money loses value over time, the real question is not just how much you save, but how much of your money is actively working while you are not. If you think inflation is just rising prices, you're only seeing the surface. Inflation is actually a silent transfer of wealth. It moves purchasing power from savers to asset holders without asking permission from either side. That is why two people earning the same income can end up in completely different financial realities. One feels constant pressure. The other feels expansion. The difference is not income. It is positioning. Let's break this down simply. When money loses value over time, holding it idle becomes a hidden loss. But when money is used to control assets that rise with inflation, it becomes protection. Think about real estate in a growing city. As inflation rises, construction costs rise, replacement costs rise, and rents often adjust upward over time. If you own the asset, inflation pushes its value and income potential higher. If you don't, you simply pay more for the same living space year after year. There was a time when a small investor hesitated for years, waiting for the perfect moment to enter the market. He held cash, believing patience was safety. But while he waited, prices quietly climbed. Eventually, the same asset he could have bought easily required far more capital. His patience did not protect him. It delayed him. Now compare that with someone who entered earlier using structured borrowing. He didn't wait for perfection. He focused on sustainability, fixed debt, manageable payments, and income-producing assets. As inflation increased, His fixed costs stayed the same, while income and asset value increased. That is the hidden advantage of understanding inflation correctly. It is not something to fear. It is something to position against intelligently. Before you continue, subscribe, like this video, and comment whether you currently feel inflation is working for you or against you. That awareness alone can change how you make financial decisions. Because here is the deeper truth. Inflation does not affect everyone equally. It rewards those who own productive assets and penalizes those who only hold idle money. And once you truly understand that, you stop asking how to avoid inflation and start asking how to position inside it. If fixed debt feels risky to you, it's probably because you've only heard one side of the story. In reality, fixed debt is not about avoiding risk. It's about controlling exposure to uncertainty. When you borrow at a fixed rate, you lock in your cost of capital. That means no matter what happens in the economy, your repayment remains predictable. Your monthly obligation does not suddenly spike when interest rates rise. This stability becomes extremely powerful during inflationary cycles. Let's make it simple. Imagine two people. One has variable rate debt, the other has fixed rate debt. When inflation rises and central banks increase interest rates, the first person's payments increase. Their financial pressure grows month after month. The second person's payments remain unchanged. But if their income or asset value is rising with inflation, their debt becomes easier to manage over time. This is where the wealthy see opportunity instead of fear. There was a property investor who locked in long-term fixed financing during a period of relatively low rates. At the time, people questioned the decision. They said he was taking on too much long-term obligation. But a few years later, interest rates rose significantly. While others struggled with higher borrowing costs or refinancing pressure, his payments stayed the same. Meanwhile, rental income increased with market demand. His spread widened naturally. Same economy, different outcomes. The difference was structure, not luck. Before you continue, subscribe, like this video, and comment whether you currently prefer fixed or variable debt, or if you avoid debt completely. Your answer reveals how you naturally respond to uncertainty. Now here's the key insight. Fixed debt is not just about protection. It is about predictability. And in finance, predictability is leverage. Because when your costs are stable, you can plan, scale, and reinvest with confidence. But there is a condition. Fixed debt only becomes powerful when it is attached to assets that can grow, generate income, or adjust with inflation. Otherwise, fixed obligations without productive output can still become a burden. So the real strategy is not just fixing your debt. It is pairing fixed debt with adaptive assets. That combination is where stability turns into advantage. The biggest mistake most people make with loans is not the loan itself. It's what they attach it to. Debt is neutral, but outcomes are not. And when people borrow without a clear purpose, they often turn a financial tool into a long-term burden. Think about how loans are usually used in everyday life. Many people borrow for consumption, lifestyle upgrades, cars that depreciate, purchases that feel rewarding in the moment, but do not generate anything back. The payment remains, but the value fades quickly. That creates pressure that builds quietly over time. Now compare that with borrowing for productive use. A loan used to acquire an income-generating asset behaves completely differently. It is not just money going out each month. It is money being recycled through a system that produces returns. There is a story of two individuals who both took loans at the same time. One used it to improve lifestyle, buying things that brought temporary satisfaction. The other used it to acquire a small rental unit in a developing area. At first, the second person also felt pressure, monthly payments, uncertainty, and responsibility. But over time, rent increased, the property appreciated, and the debt became easier to manage relative to income. One loan disappeared into consumption. The other transformed into an asset. Same banking system, same interest rates, completely different financial direction. Before you continue, subscribe, like this video, and comment what your last loan was used for. That reflection alone can reveal whether your borrowing is building or draining your future. Now here is the deeper truth. The problem is not access to loans. Most people actually qualify for more capital than they use. The real issue is lack of strategy. Without a plan for return, repayment becomes stress instead of structure. Wealthy individuals rarely ask, "Can I afford this loan?" They ask, "What will this loan produce?" That single shift changes everything. Because once a loan is tied to production, it becomes part of a system instead of a standalone liability. And in finance, systems scale. Random decisions do not. If you think your income is the most important factor in getting access to loans, you are only partially correct. Income matters, but what matters more is how stable, predictable, and structured that income appears to a lender. Banks are not trying to decide how ambitious you are. They're trying to measure how likely you are to repay without disruption. That means they care less about spikes in income and more about consistency over time. Think about it from their perspective. A person earning a high but irregular income is riskier than someone earning a moderate but stable income. Because stability reduces uncertainty, and uncertainty is what financial institutions try to minimize. This is why credit profiles often matter more than income alone. Your credit history tells a story. It shows whether you manage obligations consistently, whether you overextend yourself, whether you honor commitments even when conditions change. There was a professional who earned well but struggled to get favorable loan terms. His income fluctuated significantly due to freelance work. On paper, he was successful, but to lenders, his pattern looked unpredictable. Later, he adjusted his financial behavior. He stabilized cash flow reporting, reduced unnecessary credit utilization, and built a consistent repayment history. Over time, his borrowing power increased, even though his income did not dramatically change. What changed was perception of risk. Before you continue, subscribe, like this video, and comment whether you believe income or credit history is more important in your financial life. That answer often reveals how you currently interact with the system. Now here's the deeper insight. Credit is not just a score. It is a reflection of trust built over time. And trust in financial systems translates directly into cost of capital. The better your profile, the cheaper your money becomes. Cheaper capital changes everything. It increases spread. It improves cash flow. It expands opportunity. And over time, it compounds into a structural advantage that most people never notice because they never focus on building it. So the real goal is not just to earn more. It is to become financially reliable in the eyes of the system that allocates capital. Most people believe credit score is just a number, something you check before applying for a loan. But in reality, your credit profile is closer to a financial reputation system. It tells the entire financial world how you behave when money is on the line. And reputation in finance is not built overnight. It is built through repetition, discipline, and time. Think of it like this. Every payment you make, every credit line you manage, every decision to borrow or not borrow, all of it is being recorded into a long-term pattern. That pattern becomes your identity in the eyes of lenders. Now here is where the shift happens. A strong credit profile does not just help you get approved. It changes the cost at which you access money. And in finance, cost of capital is everything. Imagine two individuals. One has average credit behavior, late payments, high utilization, inconsistent borrowing habits. The other pays on time, keeps utilization low, and maintains long-term accounts. When both apply for financing, they may both get approved, but the second person gets significantly better terms. Lower interest, higher limits, more flexibility. That difference might seem small at first, but over time it compounds. Lower interest means lower monthly burden. Lower burden means more free cash flow. More free cash flow means more ability to reinvest. And reinvestment is where wealth actually accelerates. There was an investor who once ignored credit entirely, believing cash was all that mattered. He paid higher rates simply because his profile was weak. Later, he realized that improving his credit behavior was not about borrowing more, but about borrowing smarter. Within a few years of disciplined behavior, his financing costs dropped significantly. Without increasing income, his financial capacity expanded. Before you continue, subscribe, like this video, and comment if you actively track your credit profile or if you have never checked it. That single habit alone separates casual money users from structured financial builders. Now here is the deeper truth. Credit score is not just about debt. It is about trust under pressure. It shows how you behave when obligations exist and conditions change. And once you understand that, you stop treating credit like a tool you use occasionally and start treating it like a system you continuously build. If you walk into a bank thinking you are just applying for money, you are already in the weakest position in the room. Because the real goal is not to get approved. The real goal is to be seen as low-risk capital behavior in motion. Banks don't just lend money, they allocate trust. And trust is not emotional in their world. It is calculated through patterns. Your financial behavior becomes a signal, and that signal determines how much power you actually have. Now here's the mindset shift most people miss. A strong borrower is not someone who needs money. A strong borrower is someone who already behaves like they don't need it. Think about that carefully. When someone walks in desperate for funding, every detail signals pressure. But when someone walks in with liquidity, structure, and options, they signal control. And control is what lenders want to be part of. There was a small business owner who applied for funding multiple times and kept getting average terms. Nothing was wrong with his business, but his financial presentation looked reactive. Then something changed. He stopped treating credit as an emergency tool and started building it as a system. He maintained cash reserves, reduced unnecessary utilization, and organized his financial records properly. The next time he applied, not only was he approved, but multiple financing options were offered. Same person, same income, different perception of risk. Before you continue, subscribe, like this video, and comment if you have ever felt judged by a bank or financial institution. That experience often reveals more about structure than income. Now here is the deeper layer. Creditworthiness is not built in the moment of application. It is built long before you ever need capital. It is shaped by your habits, your discipline, your consistency, and your ability to manage financial responsibility without pressure. And when those signals are strong enough, something interesting happens. You stop chasing capital, and capital starts becoming available to you on better terms. That is when the game shifts from borrowing money to structuring opportunity. Most people think borrowing power starts when they apply for a loan. In reality, it starts years before that moment, in how they manage money when no one is watching. Because lenders are not just evaluating your current situation. They are evaluating your pattern of behavior over time. And patterns are built through habits, not applications. Now here's the shift. Strong borrowing power is not created at the bank. It is created in your daily financial discipline. Think about someone who always pays on time, keeps balances low, avoids unnecessary credit usage, and maintains stability across accounts. To them, it feels normal. But to the financial system, it signals reliability. And reliability reduces risk. When risk goes down, access goes up. There was a professional who never thought much about credit structure. He focused only on earning more. But when he finally tried to scale a business using borrowed capital, he realized something unexpected. His income was fine, but his financial structure was weak. High utilization, scattered accounts, no clear history of disciplined credit behavior. That weakness translated into higher costs and stricter conditions. Later, he changed his approach. He treated credit like a long-term system. He stabilized usage, reduced unnecessary accounts, built consistency in payments, and maintained liquidity instead of constantly stretching finances. Over time, his borrowing capacity improved significantly without any major increase in income. Before you continue, subscribe, like this video, and comment if you have ever focused more on income than structure. Most people do, until structure becomes the limiting factor. Now here is the deeper truth. Banks don't reward effort. They reward predictability. Because predictability reduces uncertainty, and uncertainty is what increases cost. And once you understand this, you realize something important. Financial power is not just about how much you earn. It is about how safely and predictably you behave with what you already have. If you believe liquidity is just cash sitting idle, you are missing one of the most powerful forms of financial strength. Because liquidity is not about inactivity, it is about readiness. In simple terms, liquidity is the ability to act when opportunity appears without needing permission, approval, or panic selling. And in the real financial world, speed often matters more than size. Think about two investors during a market downturn. One has all their money fully invested with no buffer. The other keeps a portion of capital liquid, not because they fear investing, but because they understand cycles. When prices drop and opportunities appear, the first investor is forced to watch. The second investor is able to act. Same knowledge, same ambition, different position. There was a case of a property buyer who found an undervalued asset during a temporary market slowdown. The price was significantly below average, but the opportunity required quick execution. Many interested buyers existed, but most were financially stretched. The buyer who had liquidity ready was the one who secured the deal. Not because he was the richest, but because he was prepared. Before you continue, subscribe, like this video, and comment whether you currently hold emergency cash reserves or stay fully invested. That decision quietly defines your flexibility. Now here's the deeper insight. Liquidity is often misunderstood as inefficiency because it doesn't look like growth on paper. But in reality, liquidity is optionality. And optionality is power. When you have liquidity, you are not trapped in your current position. You can refinance, you can invest, you can wait, you can negotiate. You're not forced into decisions driven by pressure. But without liquidity, even good opportunities can turn into bad decisions simply because you lack flexibility. And this is why sophisticated investors never treat liquidity as wasted capital. They treat it as strategic control. If you hear the phrase financial spread and it sounds technical, simplify it immediately in your mind. Spread is just the gap between what your money costs and what your money earns. And that gap is where wealth is either created or destroyed. Let's make this real. If you borrow money at a certain interest rate and use it to generate a higher return, the difference is your spread. Positive spread means growth. Negative spread means loss, even if everything looks active on the surface. Now here's where most people get confused. They think borrowing alone creates wealth. It does not. Borrowing only creates leverage. It is the spread that determines whether that leverage becomes powerful or painful. Think about two individuals again. One borrows at a high cost and invests in something that barely generates returns. On paper, they're investing, but in reality, their spread is negative. They're working harder just to stay in place. The second person borrows at a controlled cost and deploys capital into a cash-flowing asset that consistently outperforms that cost. Over time, the gap between income and debt service becomes their engine of wealth creation. There was an investor who once said he doesn't focus on how much money he can borrow, but on how wide his spread can be maintained safely. That mindset changed everything for him. Instead of chasing deals, he started filtering them through one question. Does this improve or weaken my spread? Before you continue, subscribe, like this video, and comment whether you have ever calculated your own financial spread, or if this is the first time you're hearing it in this way. Now here's the deeper truth. Spread is not just about numbers. It is about control. Because when your spread is positive and stable, you gain breathing room. And breathing room in finance is what allows compounding to actually work without stress. And once you start thinking in terms of spread instead of just income or debt, your entire financial decision-making becomes sharper, calmer, and more strategic. If you want to understand how wealth actually scales, you have to stop thinking in terms of earning more and start thinking in terms of control over assets using other people's capital. That is where leverage becomes powerful. Leverage is not just borrowing. It is the ability to control a larger asset base than your own money alone would allow, while carefully managing risk so that growth exceeds cost. Now here's the shift most people never make. They see debt as pressure. Wealthy individuals see debt as acceleration, but only when it is structured correctly. Think about this clearly. If you use your own money to buy one asset, your growth is limited by your capital. But if you use borrowed capital carefully to control multiple income-producing assets, your exposure to growth expands significantly. There was an investor who started small, but instead of waiting to accumulate large savings, he focused on acquiring one cash-flowing asset using a controlled loan. That asset paid down part of itself over time. Instead of stopping there, he used the equity and cash flow to position for another asset. Slowly, his portfolio began to grow not just from his income, but from the structure of reinvestment supported by leverage. Before you continue, subscribe, like this video, and comment if you currently view leverage as risky or necessary. That belief will shape how you use money going forward. Now here is the deeper truth. Leverage is neutral. It does not guarantee success or failure. It amplifies structure. If your structure is weak, leverage exposes it. If your structure is strong, leverage accelerates it. And this is why wealthy individuals do not rush into borrowing. They design first, calculate spread, test stability, and only then deploy capital. Because in their world, leverage is not about taking risk. It is about controlling outcomes through structure. Most people assume that if they get access to good loans, wealth will automatically follow. But reality is more uncomfortable. Even with favorable financing, many people still lose money because the underlying asset or strategy is weak. A loan does not fix a bad decision. It only scales it. Think about this carefully. If you borrow money and invest it into something that does not produce stable income or long-term value, you are not building wealth, you're just amplifying uncertainty. And uncertainty becomes expensive when leverage is involved. There was an individual who borrowed successfully at a very attractive rate. On paper, it looked like a smart move. But the asset he chose was speculative and depended heavily on short-term market sentiment. When conditions changed, income dropped, stress increased, and he was forced to exit at a loss. The loan itself was not the problem. The lack of structure was. Now compare that with someone who uses the same loan structure but applies it to a cash-flowing asset with stable demand. Even if growth is slower, the consistency of income allows the debt to be serviced safely while equity builds over time. One approach feels exciting. The other feels controlled. Only one survives cycles. Before you continue, subscribe, like this video, and comment whether you believe most financial losses come from bad borrowing or bad investing decisions. The answer shapes how you should approach leverage. Now here's the deeper truth. Debt magnifies whatever you attach it to. If you attach it to volatility, it becomes dangerous. If you attach it to stability, it becomes productive. And this is why experienced investors don't just ask how much they can borrow. They ask what kind of structure they are building under that borrowing. Because leverage without quality assets is just speed without direction. If you want to understand wealth creation at a deeper level, you need to stop thinking of debt as something you use once and start thinking of it as something that must have a strict purpose. Because borrowing without purpose is where most financial damage begins. There's a simple rule that separates structured borrowers from emotional borrowers. Structured borrowers only borrow when the asset produces more than the cost of the debt. Emotional borrowers borrow because they want something now. Now here is where it becomes interesting. Cash flow is what transforms debt from a liability into a system. Without cash flow, every repayment comes directly from your personal income. With cash flow, the asset begins to participate in its own financing. Think about a rental property. If it generates consistent monthly income, that income can cover part or all of the loan repayment. Over time, as rents increase and principal reduces, the burden of the debt decreases while ownership increases. The loan becomes a temporary bridge, not a permanent strain. There was an investor who made a simple rule for himself. He refused to borrow unless the asset could demonstrate realistic cash flow under conservative assumptions. He ignored optimistic projections and focused only on worst-case stability. That discipline protected him during market fluctuations that affected others more aggressively. Before you continue, subscribe, like this video, and comment if you currently evaluate loans based on emotion or cash flow analysis. That difference is what separates pressure from structure. Now here is the deeper truth. Cash flow is not just income. It is stability under leverage. It is what allows debt to exist without stress. Without cash flow, debt becomes dependency. With cash flow, debt becomes leverage. And once you start evaluating every loan through the lens of cash flow first, your decisions become more disciplined, more predictable, and far more sustainable over time. If you only compare real estate and business debt on surface level, you miss the real question. It is not which one is better, but which one compounds faster under leverage when structured correctly. Real estate debt is often considered safer because it is backed by physical assets. It tends to produce predictable cash flow if chosen correctly, especially in stable locations. The income is relatively steady, and appreciation can add a long-term layer of growth. But it is often slower in scaling unless additional leverage is continuously applied. Business debt, on the other hand, is more dynamic. It can scale faster, but it also carries higher variability. If the business model is strong, demand is consistent, and margins are healthy, borrowed capital can accelerate growth significantly. Revenue can increase beyond what traditional assets typically achieve in the same time frame. Now imagine two people. One uses leverage to acquire a rental property with stable tenants and predictable returns. The other uses leverage to expand a service-based business that has strong demand and scalable operations. The first grows steadily. The second may grow faster, but also faces more operational complexity. There was an entrepreneur who started in real estate for stability. Over time, he realized his understanding of cash flow and leverage gave him confidence to expand into a business. He didn't abandon real estate. He used it as a foundation while experimenting with higher growth opportunities. That balance allowed him to manage risk while still pursuing expansion. Before you continue, subscribe, like this video, and comment whether you would personally feel more comfortable using debt in real estate or in business. Your answer often reflects your natural risk tolerance. Now here is the deeper insight. Real estate debt builds stability. Business debt builds velocity. One protects, the other accelerates. And intelligent wealth builders don't choose blindly between them. They combine them based on structure, timing, and cash flow strength. Because in the end, it is not about the category of debt. It is about how well that debt is aligned with predictable returns and controlled risk. If you truly want to understand how debt creates wealth instead of stress, you have to understand one thing clearly. Cash flow is the bridge between borrowing and freedom. Without cash flow, debt is just an obligation. With cash flow, debt becomes a self-supporting system. Think of it like this. Every month, a loan demands payment. If that payment comes from your personal income, the pressure increases. But if that payment comes from an asset that produces income, the dynamic changes completely. You're no longer feeding the debt. The asset is participating in it. Now imagine a rental property that generates consistent monthly income. Part of that income goes toward loan repayment, part covers maintenance, and the remaining portion builds surplus. Over time, as rents adjust and principal reduces, the system becomes stronger instead of weaker. The debt slowly shrinks while the asset grows in value. There was a small investor who started with a single property. At first, the cash flow was small and the responsibility felt heavy. But instead of seeing the loan as pressure, he focused on improving the asset, managing tenants better, and maintaining consistency. Over time, small improvements in rent and occupancy changed everything. What once felt like a burden turned into a stabilizing income source. Before you continue, subscribe, like this video, and comment if you currently have any asset that generates income or if your income comes only from active work. That distinction is critical. Now here is the deeper truth. Cash flow is what transforms debt from a fixed liability into a flexible structure. It gives you room to breathe, adjust, and scale without panic. And once you start prioritizing cash flow over speculation, your entire approach to borrowing changes. You stop chasing loans for consumption and start using leverage only where the system can support itself over time. Before we dive in, remember this is not theory anymore. This is how money actually moves in the real world. And if you apply even a fraction of this correctly, your financial trajectory can shift over time. If you're getting value from this series, make sure to subscribe, like, and comment what part is hitting you the hardest, because that feedback shapes what comes next. You were never meant to think of debt as danger. You were trained to fear it. But in reality, debt is neutral. It is simply power with a cost attached. The real difference is who controls the terms. Think about two people. One borrows to buy liabilities, the other borrows to acquire income-producing assets. On paper, both are in debt. In reality, only one is building escape velocity. The mistake most people make is assuming debt is the problem, when in truth, misallocated debt is the problem. When debt is tied to something that grows in value or produces consistent cash flow, it stops being a burden and starts behaving like an engine. And once that engine is running, inflation actually becomes your silent partner instead of your enemy, because your repayment stays fixed while your income expands. This is where financial positioning matters more than effort. You don't need to work harder. You need to position smarter. The wealthy don't chase debt freedom first. They chase income expansion first. And that sequence changes everything. Now let's go deeper into something most people completely misunderstand: cash flow, timing, and survival pressure. When people hear leverage, they imagine profit. But professionals think in survival windows. Because it's not just about whether an asset makes money. It's about when that money arrives. A real estate investor, for example, doesn't just ask, will rent cover the mortgage, but will rent consistently cover it even during vacancy cycles, repairs, and market slowdowns? That small shift in thinking separates investors from speculators. Imagine someone buys an asset that produces income, but that income arrives irregularly or unpredictably. Even if the long-term math looks good, the emotional pressure becomes unbearable. They start making reactive decisions, selling too early, refinancing poorly, or pulling out at the wrong time. Not because the investment was bad, but because the timing of cash flow didn't match their financial obligations. This is where leverage becomes psychological as much as mathematical. If your debt payments are fixed, but your income fluctuates, stress becomes part of your daily life. But if your income is stable or increasing while your debt remains fixed, you gain breathing room. And breathing room creates better decisions. Better decisions create better outcomes. There's also another layer most people miss: buffer capital. The wealthy don't operate at zero margin. They assume delays, unexpected costs, and temporary disruptions. That buffer is what allows them to stay calm when others panic. Because in real markets, nothing moves perfectly. Tenants leave, businesses slow down, payments get delayed. The question is not, will things go wrong, but can your structure survive when they do? Once you understand this, you stop thinking like someone trying to avoid risk and start thinking like someone designing for endurance. And endurance is what turns leverage from fragile into powerful. If you want to understand real leverage, you have to understand one uncomfortable truth. Risk is never removed. It is only transferred or reshaped. Most beginners think the goal is to eliminate risk completely. That mindset leads to inaction because every opportunity contains uncertainty. Professionals don't chase zero risk. They design risk they can survive. And that difference is everything. Think about a simple scenario. Two people buy assets using loans. One structures everything tightly, leaving no buffer. The other deliberately leaves room: cash reserves, lower loan-to-value, and flexible repayment options. On paper, both look similar. But when something unexpected happens, interest rates rise, tenants delay rent, or the market cools, one panics while the other adjusts. This is where leverage becomes either dangerous or powerful. Not because the tool changed, but because the structure around it changed. A well-designed structure assumes volatility. It expects discomfort. It plans for imperfect conditions. That's why it survives. Now, here's where psychology becomes critical. When people are under pressure, they don't act rationally, they act emotionally. They sell too early, they freeze at the wrong time, or they double down blindly. The wealthy avoid this not because they feel less fear, but because their system absorbs shocks before emotion takes over. There's also a hidden advantage in structured risk. Optionality. When you have flexibility, you can choose your response instead of reacting. You can refinance instead of panic selling. You can hold instead of exiting. You can expand instead of retreating. Optionality is what turns uncertainty into opportunity. So the real question is not, how do I avoid risk, but how do I design risk that doesn't destroy me when conditions change? Because once your system can survive stress, you stop making defensive decisions and start making strategic ones. At some point in every financial journey, the conversation shifts from how do I make more money to how do I protect what I'm building? And this is where capital structure becomes more important than capital itself. Most people think wealth is about accumulation, but accumulation without structure is fragile. You can have income, assets, and even leverage, but if everything is exposed in one direction, a single shock can reset years of progress. That's why professionals don't just build wealth, they organize it. Think of two individuals again. One has all their exposure tied to one income stream or one type of asset. The other spreads exposure across different income sources, different durations, and different risk profiles. When one area slows down, the others continue to function. That stability is not luck, it's design. This is where leverage becomes more advanced. Instead of just borrowing for growth, you begin thinking about balance. Fixed versus variable obligations. Short-term versus long-term commitments. High-risk versus low-risk returns. The goal is not uniformity, it's balance under pressure. Now here's something most people overlook: correlation risk. It's not just about owning different things. It's about owning things that don't all fail at the same time. If everything you own reacts the same way to a market shift, you don't actually have diversification. You have hidden concentration. Professionals reduce this by spreading exposure across different drivers of income. Some assets respond to inflation, others to consumption demand, others to long-term contracts. This creates a system where no single event determines survival. And when structure is balanced like this, decision-making changes completely. You stop reacting to short-term fear because no single outcome defines you. Instead, you focus on long-term positioning, knowing your system can absorb shocks and continue functioning. That's when leverage stops being stressful and starts becoming strategic. Now we move into a concept most people never consciously understand, yet it quietly decides whether wealth compounds or collapses. Leverage decay over time. When people borrow, they assume the structure they set today will remain stable tomorrow. But in reality, every financial structure slowly changes as time passes. Interest rates shift, asset values move, income fluctuates, and personal circumstances evolve. This means leverage is never static. It is constantly aging. Think about someone who takes on a loan when conditions are favorable. At the beginning, everything looks comfortable. Payments are manageable, income covers expenses, and the asset performs well. But over time, small changes start to accumulate. Maybe costs rise slightly. Maybe income grows slower than expected. Maybe market conditions tighten. Individually, none of these seem dangerous. But together, they reshape the entire equation. This is what professionals understand deeply. Leverage must be actively managed, not passively held. You don't just set and forget financial structures. You monitor them like a system under constant pressure. Because what was safe at the start can become risky later if conditions change. Now here's where strategy matters. Good investors don't just think about entry. They think about exit flexibility from day one. Can this debt be refinanced if conditions improve? Can it be adjusted if conditions worsen? Can it be reduced without destroying the underlying asset? These questions determine long-term survivability. There's also a psychological layer. As time passes, familiarity creates complacency. People stop evaluating risk because nothing has gone wrong yet. But that comfort is exactly what hides future vulnerability. The absence of crisis is not proof of safety. It is only a snapshot in time. So the real skill is this: continuously reevaluating leverage as if you were entering it today under current conditions. That mindset keeps your structure alive, adaptive, and resilient. Because in long-term wealth building, survival is not about the initial decision. It's about how well that decision holds up over time. Now let's talk about something that quietly separates stable wealth from fragile wealth: the cost of capital and how it shapes every decision you make. Most people think a loan is just money you borrowed, but professionals see something very different. They see a price attached to every unit of capital. That price determines whether an opportunity is strong or weak, not the opportunity itself. Imagine two people looking at the same investment. On the surface, it looks identical for both. But one person borrows at a low cost of capital, while the other borrows at a much higher cost. The same asset suddenly produces two completely different outcomes. For one, the spread is positive and compounding begins. For the other, margins shrink and stress increases. This is why sophisticated investors obsess over terms, not just access. Interest rate, repayment structure, flexibility, penalties. These are not details, they are the entire outcome. A small difference in cost can compound into a massive difference in long-term wealth. Now here's the deeper insight. Cost of capital is not only external, it is also internal. Your financial discipline, credit profile, liquidity, and reputation all influence how cheaply or expensively you can access money. Two people in the same market can experience completely different borrowing conditions simply because one is perceived as lower risk. And perception matters more than most realize. Banks and lenders are not just evaluating numbers. They are evaluating behavior over time. Consistency, repayment history, and stability reduce perceived risk, which lowers your cost of capital. That lower cost quietly becomes a long-term advantage. But there is also a trap here. When people gain access to cheap capital, they sometimes confuse affordability with opportunity. Just because money is cheap does not mean every use of it is intelligent. The real skill is not borrowing cheaply. It's deploying capital in a way that produces returns higher than its cost, consistently and sustainably. Because once you understand cost of capital, every financial decision becomes a comparison. What does this money cost me, and what does it return in exchange? That simple question is the foundation of intelligent leverage. Now let's go one layer deeper into something most people never track properly, yet it quietly determines whether leverage builds wealth or drains it: cash flow protection under stress. When everything is going well, almost any structure looks stable. Income is flowing, payments are on time, and confidence is high. But real financial strength is not measured in good conditions. It is measured in bad ones. Imagine an investor who builds a portfolio or business using borrowed money. In normal conditions, everything works smoothly. But then a disruption happens. Income slows, expenses rise, or collections delay. This is the moment where weak structures start to collapse. Not because the idea was wrong, but because there was no protection built into the system. Professionals design for this exact moment in advance. They don't ask, what happens if everything goes right? They ask, what happens if income drops by 20%, 30%, or even temporarily pauses? That stress test changes how they structure everything, from debt size to repayment flexibility to reserve requirements. This is where liquidity becomes critical. Cash reserves are not idle money. They are survival time. They buy you the ability to think clearly when others are forced to react. Without liquidity, even a good asset can become a source of pressure. With liquidity, even a difficult period becomes manageable. There's also a behavioral side that people underestimate. When financial pressure increases, decision quality decreases. People start making short-term choices that damage long-term outcomes, selling assets too early, accepting bad refinancing terms, or exiting strong positions out of fear. That's why the wealthy prioritize breathing room over maximum deployment. They would rather earn slightly less in ideal conditions than risk being forced into bad decisions under stress. Because one bad decision under pressure can undo years of compounding. So the real goal of leverage is not just profit. It is survivability with flexibility. A structure that can bend without breaking, adjust without collapsing, and continue operating even when conditions are not perfect. That is what separates fragile growth from durable wealth. Now let's talk about something that quietly determines who survives financial cycles and who gets forced out: liquidity, timing, and access speed. Most people think liquidity simply means having cash. But in real financial systems, liquidity is not just about what you have. It's about how quickly you can access it when pressure appears. That difference changes everything. Imagine two individuals facing the same opportunity or crisis. One has cash sitting idle, ready to deploy or cover obligations immediately. The other technically has assets of equal or greater value, but those assets take time to convert into usable money. On paper, they're equally wealthy. In reality, their flexibility is completely different. This is why professionals treat liquidity as a strategic layer, not just a backup. It is not money waiting for emergencies. It is power waiting for timing. Because in real markets, timing often matters more than total value. Now think about leverage in this context. When you borrow, you are creating fixed obligations. Those obligations do not wait for your assets to become liquid. They arrive on schedule, regardless of your situation. That is why liquidity mismatch is one of the most dangerous hidden risks in any leverage system. A strong structure ensures that cash flow and liquidity timing align with obligations. It means income arrives in a predictable rhythm, reserves exist for delays, and access to additional capital is possible without panic. This alignment is what keeps pressure from turning into crisis. There is also a psychological advantage here. When you know you have liquidity, your decision-making improves instantly. You stop reacting emotionally because you are not forced into urgency. You can negotiate, wait, restructure, or even walk away from bad terms. Lack of liquidity removes options. Liquidity restores them. And in wealth building, options are everything. Because options allow you to choose instead of react. And the ability to choose under pressure is what separates strategic investors from desperate ones. Now let's explore something that looks simple on the surface, but quietly shapes long-term outcomes more than most complex strategies: debt maturity planning. Most people only think about how much they borrow and at what rate. But professionals think about something deeper: when that debt must be repaid or refinanced. Because timing of obligations can create either stability or pressure, depending on how it is structured. Imagine someone who takes multiple loans without considering their maturity dates. On paper, everything seems manageable. But if several obligations come due at the same time, even a strong portfolio can feel stress. Not because the assets failed, but because the timing of repayment creates a liquidity crunch. This is why sophisticated investors stagger their debt. They deliberately avoid having everything mature in the same cycle. Instead, they spread obligations across time so that no single year carries overwhelming pressure. This creates breathing room, and breathing room is what prevents forced decisions. Now think about what happens when structure is ignored. If too many obligations cluster together during a market downturn or income slowdown, the investor is forced into reactive choices: refinancing under bad conditions, selling assets at lower prices, or taking on expensive short-term solutions. Not because the assets are weak, but because timing was poorly designed. Professionals avoid this by treating debt like a timeline, not a single event. They map out when obligations begin, when they peak, and when they end. That way, they're never surprised by liquidity demands. Everything is anticipated. There is also a strategic advantage in staggered maturity. It gives you flexibility to refinance when conditions improve. If interest rates drop, you can restructure portions of your debt instead of being locked into a single fixed cycle. This allows the system to adapt instead of break. So the real insight is this: leverage is not just about access to money. It is about control over time. And when you control timing, you reduce pressure. And when pressure is reduced, decision quality improves. That is how structure quietly becomes strength. Now let's focus on a concept that most people completely overlook, yet it determines whether leverage becomes a tool of growth or a source of constant stress. Margin of safety in real financial structures. Margin of safety is not just a number. It is a buffer between your expectations and reality. is the space that protects you when things don't go as planned. And in real markets, things rarely go exactly as planned. Imagine someone builds a financial structure where everything is calculated based on perfect conditions. Full occupancy, stable income, consistent rates, and no unexpected costs. On paper, it looks efficient, but efficiency without buffer is fragile. The moment reality shifts even slightly, pressure begins to build. Now compare that with a structure that intentionally assumes imperfection. Slightly lower income assumptions, slightly higher expense projections, extra liquidity held back instead of fully deployed. At first glance, it may look less aggressive, but in reality, it is far more resilient. This is where professionals separate themselves from amateurs. Amateurs optimize for maximum return in ideal conditions. Professionals optimize for survival across all conditions. Because they understand something critical. Wealth is not built by the best-case scenario. It is preserved by worst-case survivability. Margin of safety also has a psychological effect. When your structure has breathing room, your mind operates differently. You stop reacting to small fluctuations. You stop panicking during temporary downturns. You gain the ability to think strategically instead of emotionally. There's also a compounding advantage here. When you're not forced into emergency decisions, you avoid value destruction, like selling assets under pressure or refinancing at bad terms. Instead, you stay positioned long enough for compounding to work in your favor. So the real lesson is simple but powerful. Leverage without margin is exposure. But leverage with margin becomes control power. And control power is what allows wealth to grow without collapsing under its own weight. Now let's bring everything closer to a real-world insight that most people only learn after mistakes. Leverage is not just about growth. It is about control under uncertainty. When people first discover leverage, they focus on expansion. Bigger assets, higher returns, faster growth. But professionals focus on something more subtle. Control when conditions stop behaving predictably. Because in reality, uncertainty is not an exception. It is the environment. Interest rates change, markets shift, income fluctuates, policies evolve, and timing never stays perfect for long. The question is not whether uncertainty will come, but whether your structure can remain stable when it does. Think about two individuals again. One builds aggressively without considering variability. Everything works fine in stable conditions, so confidence grows. But the moment volatility appears, pressure rises quickly because there is no buffer, no flexibility, and no room to adjust. The other person builds slower, but with control in mind. They don't just ask how much they can borrow. They ask how much they can withstand if conditions worsen. That single difference changes everything. Because when uncertainty arrives, one person is forced to react, while the other can still choose. This is where true leverage maturity begins. You stop thinking in terms of maximum return and start thinking in terms of sustainable operation. You begin designing systems that don't break under pressure, but adjust under pressure. And this mindset changes behavior completely. You become less emotional with decisions. You don't chase every opportunity. You don't panic during slowdowns. Instead, you evaluate continuously, adjust strategically, and stay within a range where control is always preserved. Because at the highest level, wealth is not about how fast you can grow. It is about how long you can stay in the game without being forced out. And control is what keeps you in the game long enough for compounding to actually matter.